Everyone, welcome to this week's Nasdaq Dorsey Wright podcast. What is today? Thursday, June 22nd, coming out Friday, June 23rd. Miles and I here. We're going to run through some spread type of pieces that we've been putting out in the report over the past month. Seems to always shock us how much Nasdaq 100 growth, whatever it may be, has been outperforming the rest of the field so far this year. So we're going to kind of quantify that today with some, I think, pretty relevant tables. Then we're going to end with one thing on the platform that we think is relevant. Miles has his idea. I have mine. I don't know what he's going to say.
Who knows? We'll keep it a secret.
Yeah. But the first thing we want to talk about is we're closing out the month of June, almost towards the end. S&P 500 likely going to be up more than 10% for the first 6 months of the year. Not a very common feat, as we put in our report recently back. Miles, you were digging through this a little bit here where we had first 6 months, second 6 months, because people always ask, like, if you're up over 10% for the first 6 months of the year, are all your gains done? Does the market keep going? Data would suggest that the market tends to keep going.
Yeah, I mean, as they say, let the good times roll. You through the first 6 months going back to all the way through 1929. We're going to throw this table up on the screen here. But as you can see, if you go back to 1929, that's the last time. That was a pretty bad year, right? But all things considered, but that was the last time that we started the year up more than 10% and ended the year negative. So history suggests, knock on wood, right? History suggests that we're probably going to have at least a positive gain for this year.
Yeah, no, so that's a good point of clarification, is that you were up 13%, and this is 1929. First 6 months of 1929, you were up 13%. Second 6 months, you were down 22, which put your calendar year point-to-point return of like minus 12.
Yeah.
But if you look at specifically like just the second 6 months of the year, the last time that the market S&P was up more than 10% in the first 6 months and then put in a loss the second 6 months was 1987.
Yeah.
And of course, a lot of that was back end of the year for 1987 as well.
3 decades or so.
Yeah, 3 decades. Even though 1987 point to point, the market was still up 2%.
Right. And I'll raise you one there, Will. If you look at those instances since 1987, so, from that point on, 1989, 1991, 1995, 2003, and 13. 5 of those 10 instances since then where we saw that first 6 months return greater than 10%. The second 6 months, guess what? Also greater than 10%.
So double digit 50% of the time.
Yeah.
Positive 90% of the time is what it's been.
Yeah.
That's kind of what we're saying. Yeah. And even like 2019, that's that second 6 month, you're not far off. You're like 9.8%. So I don't know if we're including total returns here or not, but maybe with some dividends. That would get you there. So anyways, I want to begin with that piece. I think that's super relevant. People talking about, can the market keep going? Yeah, it can.
Well, how's it going to keep going? How do you think?
I think we're going to need some equal weight participation.
Oh, really?
What a transition.
Yeah. So moving on to the next kind of chart that we've got here, we've got a rolling 3-month performance spread between SPY and RSP, or cap weighted names, cap weighted kind of vehicle versus equal weighted vehicle in RSP here. This one is from about a month ago, but Will and I ran the calculation here. Spread is relatively the same. Again, SPY versus RSP outperformance. So a positive reading here is going to signify SPY is outperforming RSP, and a negative reading is going to be for the other way around.
Yeah.
RSP is outperforming there. So we are at this point in time seeing about a 5% rolling 3-month spread in favor of SPY.
Yeah, which is pretty significant when you look at over the past, 30 years. Nearly, you don't see it breach the 5% level very often, being against SPY, cap weight outperforming equal weight by more than 5% on a rolling 3-month basis. What I think is more compelling, though, is this performance table that we put in the report as well. So saying, so when the cap weight outperforms your equal weight by this magnitude, from that point forward, equal weight historically has done a lot better. Maybe that's mean reversion. You see cap weight spike during times of market turmoil, people flight to safety in equities. And then once the spread starts to revert to mean, which means that your equal weight fund, you starts out outperforming, you see a lot of alpha in favor there.
Yeah. And it's not also, I mean, you and I chat off pod there about RSP being harder to beat than SPY. Not a lot of people think that,
Yeah.
I don't think.
Yeah.
But it's not just going back to the performance table, not just 1 year out. I mean, you're also looking at shorter term averages in that performance table, the 30-day, the 90-day, 180 days, a little bit longer. But I mean, you're seeing outperformance across the board.
We get a lot of calls about like, why do you put your benchmarks versus the equal weight versus the cap weight?
Yeah.
Typically because the equal weight's been tougher to beat than the cap weight, like
Yeah.
point to point. Like maybe the past 10 years, cap weight's done a little bit better. I haven't even check the numbers on that. I might do it right now, actually.
Point to point.
Yeah, so I mean,
It's-
like point to point. The past 20 years, equal weighted is up 433%. Price return only. Cap weight is up 353%.
Yeah. So 80.
By 90%.
What's your CAGR difference?
CAGR is about 1% a year. So in addition to the S&P equal weight, S&P cap weight, some other index comparisons that we've been looking at lately has been the Nasdaq 100 and the Russell 2000. Russell 2000's had a good start to June. I think you said is outperforming the Nasdaq, right?
About 2.5%.
Like, so yes, the small cap's been beating NDX by about 2% so far in June. But for most of this year, that's not been the story. The Nasdaq 100 is having its best year of outperformance versus the Russell 2000 since data going back as far as we have, which is about the mid 90s. I think it's a near 30% outperformance versus the Russell 2000.
Looks like it, yeah.
Yeah, we can throw up this bar chart here. But what's more interesting here is not just that you've seen outperformance, but lately you've seen a dislocation between their price movement. So the correlation between the Nasdaq 100 and the Russell 2000 is going down.
So it was a rise of correlation because it was in 2022 and small caps were doing bad and NDX was doing bad.
Yeah.
So that was that rise in correlation where, okay, well then that was a rise in correlation where it was completely risk off. And now we're seeing a fallen correlation, still positive, but a decline in correlation because of what? Because small caps are still considered risky, and the NDX names, at least when we're seeing the 5 or 6 different names, you're seeing those are acting as safety. Is that what it is? Is that a reason for it?
That's what I would think. Like this chart's kind of deceptive.
Yeah.
Because like the correlation is going up. It doesn't always coincide with risk on or risk off markets. Sometimes they're going up because it's a risk off market. Other times the correlation is going up because it's a risk on market. Where like the Nasdaq 100 and the Russell 2000 are moving together.
I think it's a minefield of explanation, but I think it's a useful chart, and there's a lot to talk about, just like we just did.
Yeah. All right. So enough about the spread talk. We mentioned we want to conclude with one thing on the platform that we're looking at. I'll go first. That I've been looking at copper and gold.
I was doing that too.
Are you serious?
No, I'm just kidding.
Okay. I was about to say, I was jokingly thinking that you're going to do the same thing, and then you actually, anyways. So yeah, I've been looking at copper gold. This is on the screen now. Copper gold CPER versus GLD. That reversed up into X's yesterday, which tells us that copper CPER has outperformed gold by about 10% recently.
And you like to see that, right?
You really like to see that. I've run a lot of performance numbers on copper and gold metrics, like specifically when copper's on a buy signal versus gold, the market has done tremendously better.
That makes sense, right? So
yeah,
defensive metal versus slightly more economically useful.
Yeah,
slightly.
yeah. Gold being the like typical flight to safety, copper broadly used in the economy. So that reversal, I think, is pretty big for me. I would like to see this get back to a buy signal in favor of copper, because you got a reversal up in October of 22, which was a bottom, which was the most recent bottom for the market. This is when copper was in favor of gold again, but you're still well off the buy signal mark. You probably need another 1, 2, 3, 4, like 12 to 15% of outperformance for copper. But that's what I've been watching.
Sometimes those reversals are, I mean, you get it on the radar and you can kind of, go from there. You don't necessarily, we'd like to see a buy signal, right? But I mean, seeing that is sometimes, enough.
What do you got?
Well, what I was going to say was watch that gold chart too. further downside participation, just that's a one-off view. Further downside participation sees it post a third consecutive sell signal, move back into a negative trend for the first time since December of last year. So there's some weakness within the precious metals side of things as well. But anyways, I'll move over into what I was saying. It's going to be the BP NDX chart. So talking about Nasdaq 100 for the portion of today's kind of podcast, but hasn't quite reversed back down yet, right? We're still at a chart reading of 70% there, you know, on a buy signal, bull confirmed status within a percentage point of reversing back down into O. So a slight fall down in participation. Now, you might think that I'm going to say this is bad. I actually, hot take, I like to see this, right? Because if you read the Were You Aware piece from yesterday, where we talked about historic overbought, oversold readings for the overbought side of things for NDX, we've never seen a reading this high in decades, right? It seems like we've said a lot of things haven't been seen in decades on today's recording. But point being, it's time for a pullback, and not in a bad way. You know me, off the recording, I'm a bull in general, right? But it's time for a pullback, for it to be, you know, healthy.
Yeah.
Healthy kind of contraction. So, you know, you see a small downtick in participation, you know, it's not a bad thing in my point of view.
Yeah, people I think mistakenly think that being bullish and expecting a pullback are not mutually exclusive. That's double negative, but they can go hand in hand.
Yeah.
See, and I think it's a good call out, because that BP NDX chart, you rarely see it get above 80%, and you were knocking on the door at 80% pretty recently. So yeah, now that's a good call out. Anything else for the people?
I got nothing.
I have nothing either. Thanks everyone. We appreciate the attention. We'll see you next week.
See ya. Bye-bye.